Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing JetBlue stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. JetBlue is a low-cost airline. It operates over 1,000 flights daily and serves 100 domestic and international destinations in the US, Canada, Mexico, the Caribbean, Central America, South America, and Europe. They are not a member of any of the three major airline alliances, but it has code-share agreements with 21 airlines, including Oneworld, SkyTeam, and Star Alliance. The company is headquartered in Long Island City, New York, and was founded in 1998. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Zeta, and EuroTLX. Let's get started with the model. This is a mid-cap company, 2.3 billion market cap. They're trading at $7 a share, and they have 328 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is up and down, positive in 2019, a big negative in 2020, mainly due to COVID, back to positive in 2021, but negative in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was positive in 2019, negative after that. Revenue is a sales for the company, and that looked really good in 2019 at $8 billion. Of course, dropped a lot to 2020. Not many people traveling, down to $3 billion. Then it doubled to $6 billion in 2021. Then it went up about 50% from there to $9.2 billion. So it looks really good in 2022, but they're still losing money. This is the company's income statement from their 10K. This shows us 2020, 2021, and 2022. So their revenue for 2022 is $9.2 billion. Let's get a little more info on that number. About 2/3 of their revenue is domestic in the United States and Canada, $6 billion. Caribbean and Latin America is $3 billion. Atlantic, only $123 million. Atlantic is growing a lot. They didn't have any in 2020, $18 million in 2021. And that grew 7 times from 2021 to 2022. Just like any business, your success is based on revenues and expenses. They can make more money if they charge more per passenger, or they can make more money if they spend less on gas, but that depends on gas prices, of course. Their average fare was $186 in 2021, up to $217 in 2022. The yield per passenger mile is up from $13.60 to $16.30. A common term in airline industries is ASM, available seat mile. Their passenger revenue per available seat mile went up from $10.37 to $13.32. Operating revenue also went up from $11.16 to $14.20. The distance of the average flight went down from 1,283 miles to 1,213 miles. Revenue passengers and revenue passenger miles both went up a lot from 2021 to 2022. Available seat miles went up a lot as well, from 54,000 to 64,000. Load factor is also improving. Load factor is a percent of the plane that's full. So in 2021, only 3/4 of the plane was full. That's up to 82%. Obviously, the higher the better, because you're already paying for gas and the pilot and all the other expenses, like food and the staff. So you want to get the plane full. Let's go back to the income statement. Below revenue are the expenses. Fuel is $3 billion. That doubled from 2021, and 2021 doubled from 2020. Salary is $2.7 billion. That's also up from $2.4 billion. Landing fees are down from $628 million to $544 million, because JetBlue has to pay fees to land at each airport, because there's a finite amount of space at each location. So each airline has to pay to land their plane at the airport. And they have lots of fixed assets. Those airplanes are expensive, so they depreciate them each year, $585 million of depreciation. Aircraft rent is around $100 million a year. In order to promote their business, they spend money on marketing, $300 million. That's up from about $200 million. The maintenance and repair of aircraft was $600 million, similar to last year. In 2022, special items were $100 million. But in prior years, they had a negative, which is a gain because it's an expense. The special items in 2022 were $52 million impairment, $32 million of payroll taxes, $28 million acquisition of Spirit, and $1 million relating to the implementation of the TWU contract. Other operating expenses were $1.4 billion, last year $1.1 billion. They define other operating expenses as outside services, airport expenses. Also part of other operating expenses are professional legal fees, shop and office supplies, bad debts. Even though they had $9.2 billion of revenue, they still had an operating loss of $300 million. They paid $166 million of interest on their debt, which is lower than prior years. So their net loss for 2022 was $362 million. Last year was $182 million. In 2020 it was $1.4 billion loss. And their loss per share is $1.12. Last year was 57 cents. But it's a lot better than 2020, almost $5 loss. This is the asset section on their balance sheet, 12/31/21 and 12/31/2022. Their cash went down from $2 billion to $1 billion. They have $350 million of investment securities. Receivables are $317 million. That's how much other companies owe them. Inventory is $87 million, up from $74 million. Prepaid expenses of $120 million. A prepaid expense is when a company makes an advance payment for a product or service they're going to receive in the future. So total current assets are $1.9 billion. Last year was $3.2 billion. Current liabilities are $3.7 billion, so they have a really bad current ratio. Current ratio is current assets over current liabilities. So it looks like they're going to need to take on some more debt to get through the next 12 months. I'll show you their current liabilities in a little bit. The value of the aircraft on their balance sheet is $11.7 billion. Accumulated depreciation on the aircraft is $3.6 billion. So the carrying value of their aircraft is $8.6 billion. Other property and equipment is $1.3 billion. Total property and equipment is $9.1 billion. They have some operating leases, that's $660 million. And they have a small amount of investment securities, restricted cash, and intangibles. So their total assets are $13 billion. Last year it was $13.6 billion. This is the liability section of the balance sheet. This is what they owe. On top is accounts payable. That's how much they owe other companies for product or services they purchased on credit. Then air traffic liability, $1.6 billion. Air traffic liability is when people prepay for tickets. So it's counted as a liability on the balance sheet. And then when people actually go on the flights they prepaid for, it's removed from the balance sheet and put onto the income statement as revenue. So they did book the cash, but to offset the cash, because cash is an asset, they increased aircraft liability. That's how you get the balance sheet to balance. Then you have accrued salaries and wages, $500 million. Other accrued liabilities, $500 million. An accrued liability is when a company incurs an expense it hasn't paid yet. They owe $97 million on their operating leases, and they owe $550 million on their debt. That's the current portion. And they owe $3.1 billion on long-term debt. Here's the $554 million, the current portion of long-term debt, and the $3.1 billion of long-term debt. This is from their 10K. This table gives us a breakdown of when their debt is due. $43 million due in 2036. That's at an interest rate of 4.9%. $500 million due in 2032. Another $500 million due in 2032. Look at this debt in 2027. It has an interest rate of 8%. That's really expensive debt. So if they have a lot of debt due in 2023, for instance, that could be a concern, because they either need to use cash to pay off that debt or take on new debt to pay off that debt. They have $800 million of deferred income taxes. These are taxes a company will eventually have to pay but aren't due yet. Air traffic liability, $700 million and $500 million of other. They have $2 billion of deferred taxes and other. They bought back $2 billion of common stock. That's recorded on the balance sheet as treasury stock, which is a contra equity account, so it brings down their equity balance. That's why it's a negative. They raised $3 billion from issuing common stock and $2.4 billion of retained earnings. Retained earnings is the sum of the company's prior net incomes. So total equity is $3.6 billion. Liabilities and equity equals $13 billion, which is what assets equal. This is their statement of changes in equity. This breaks down the changes in the equity section of the balance sheet. This is the balance sheet again. You see equity was $3.8 billion in 2021, At the end of 2022 is 3.6 billion. This report, the statement of changes in equity, breaks down the difference between the 3.8 billion and the 3.6 billion. It breaks it down in a lot more detail than a balance sheet does. The difference is a $362 million loss on the income statement. That was their loss in 2022. A negative $6 million in the vesting of restricted stock units. These are incentives for employees. A $30 million expense in stock-based compensation. And $52 million of shares issued to crew members. This is the company's statement of cash flows for 2020, 2021, and 2022. And the first part of statement of cash flows is operating activities. And the way you calculate operating cash flow, you start with your net loss of $362 million. Then you have to adjust for the non-cash items on the income statement. They had a gain of $73 million on the income statement for deferred income taxes. We minus that out here. They passed through a loss of $52 million on special items. We add that back here. Since depreciation is an expense on the income statement, we add that back here. We add back $585 million. We add back $30 million of stock-based compensation. Then we have to adjust for changes in working capital. It looks like they used a bunch of inventory, so that's a cash inflow of $200 million. An increase of $30 million in air traffic liability, so it looks like they had prepayments of $30 million for tickets that people are going to use in the future. When people use those tickets, when they go on the flights they prepaid for, then air traffic liability will go down on the balance sheet, which means there'll be a negative here. Right now there's a positive because cash came in. Even though they reported an accounting loss of $362 million, they actually generated $379 million of cash flow. Last year they generated $1.6 billion. In 2020 they had a loss of $700 million. I think every airline had an operating loss in 2020. In their investing section of their balance sheet, they had $800 million of CapEx. This is the purchase of aircraft. They sold some securities and had a cash inflow of $900 million. So in 2022, they had a cash outflow of $900 million in their investing section. In their financing section, they paid back $369 million of debt. They bought back $6 million of common stock. And they had negative $37 million of other, so they had a cash outflow of $360 million in their financing section. In 2020, they had a cash inflow of $3 billion because they took on a lot of debt to get through COVID. They took on $2.5 billion of debt, another $980 million of debt, and they also added $619 million of common stock. Let's look at the capital structure. $3.6 billion of equity, $4.4 billion of debt. They're 45% equity, 55% debt. And their net debt is $3 billion. I gave them the middle WACC on Finbox. WACC is their weighted average cost of capital. That's how much money it costs this company to obtain capital. And also that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $5.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5 billion. We divide that by 328 million shares. And we get a calculated stock price of $15. They're trading at $7, so they're trading at a 54% discount. It's a buy according to the model. 6 analysts projected their revenue for 2025 to be $11.6 billion. Their projection for 2024 is $10.8 billion. For 2023, it's $10.1 billion. I continued this trend into 2026 and I got $12.4 billion. That's how I got their future revenue estimates. The average company in their industry converts 5% of their revenue into free cash flow, so I multiplied their future revenue estimates by 5%. That's how I got their future free cash flows. 6 analysts priced this stock and the average price target was $8.40, the low is $7, the high is $10. Another 11 analysts priced this stock and the average price target is $8.77. This is where the stock has been trading the last 5 years. So before COVID it was over $20, then it dropped to below $7.50, and then after about a year it got back up to over $20. Now it came crashing down to below $7. So it's a pretty volatile stock. In the past 5 years this stock is down 65%. In that same time frame, Southwest is down 43%, and United and Delta are down about 38%. They have a beta of 1.6, so the stock moves about 1.5 times the market. It's down 42% in the past 52 weeks, while the S&P is down 7%. The 52-week low is 6, the high is 14. and the stock is trading below its 50-day and 200-day moving average. This is a pretty popular stock. 7 to 8 million shares are traded each day. Pretty much all the shares outstanding are on float. 71% are held by institutions and 5% of the shares are shorted. They've done 3 stock splits, all 3 for 2s in 2002, 2003, and 2005. If you invested $10,000 into this company 10 years ago, after about 2 years, you'd be at $35,000. But if you're still holding on, you'd be back to where you were at $10,000. Not too happy. The CEO's salary is $600,000 a year, and their total compensation package is $3.5 million. 71% of the company is held by institutions, 29% by the general public, 0.3% by insiders, and 0.04% by the government. Their employee count is a little up and down over the years. They're pretty close to their all-time high currently at 24,000 workers. Their biggest shareholders, Vanguard at 10%, then BlackRock at 9%, Wellington, Dimensional Fund, Donald Smith, State Street, US Global, Fidelity, Renaissance, and PrimeCap. The best way to look at ratios is to compare them to companies in the same industry. There are 15 companies in the same industry as JetBlue, and if JetBlue has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They do spend less than average in CapEx, $900 million, average is $1.5 billion. Their debt to equity ratio is a lot better than average. They're 1.2, average is 2.7. Southwest looks really good at 0.9. They do not pay a dividend, only Spirit and Southwest pay a dividend. Most companies are losing money in this industry, except United. They had a really good year at $1.5 billion free cash flow. They rank 6th in market cap, $2.3 billion, average is $5.4 billion. Delta is number 1 at $21 billion. They have a really good price to book and price to sales, but we can't look at their PE or price to free cash flow. They generate $9.2 billion of revenue, which is lower than average. Their 5-year annual revenue growth rate is 5%, which is average, and they have a negative ROA and ROE since they have negative net income. Let's go through some of their slides from their fourth quarter presentation. A big win for this company is the acquisition of Spirit. The Biden administration sued to block this merger. They said it would create unfair competition, but it looks like the deal is going through. I know Frontier Airlines was also looking to acquire Spirit. In this slide, they talk about their revenue growth and cost cutting to build margins back to 2019 levels. They're on track to deliver $250 million of cost reductions through 2024. And to do that, they're going to retire older planes, the E190 retirements. This sets the foundation for long-term margin expansion. They're trying to restore utilization. As we saw earlier, they were about at 81% compared to 75% last year. They're projecting EPS in 2023 to be 70 cents to $1. I'd be happy if it was just positive, let alone this high. They rank 3rd in debt to capital. The lower the number, the better. This is debt over capital. You want to have less debt and more capital. American is over 100%. That's pretty bad. Southwest is number 1 at 48%. Alaska is number 2 at 53%. They may have liquidity problems because as we looked earlier on their balance sheet, their current ratio is pretty bad. But they say they expect to maintain liquidity of $1.5 to $2 billion, which is 20% of their 2022 revenue. We are managing liquidity based on our CapEx forecast and shareholder prepayments related to the Spirit transaction. And they intend to finance a portion of aircraft deliveries to maintain healthy liquidity. They estimate fuel prices to be $3.20 to $3.35 in the first quarter, and that's expected to go down for full year 2023 from $2.95 to $3.15. Of course, this is a forecast. No one really knows the future of fuel prices. They expect their interest expense to be about $200 million for 2023. Their earnings per share between 70 cents and $1. And they expect a loss in the first quarter of 45 cents per share, maybe 35 cents. Here's their delivery schedule for 2023. 11 A220 aircraft, 4 A321neos, 4 long-range neos, so that's 19 total aircraft. They have 43 contractual deliveries for 2024. They plan to return 10 aircraft in 2023 and 24 in 2024. JetBlue only uses Airbus aircraft, while Southwest only uses Boeing. And both follow the same model, the point-to-point system, not the hub and spoke. like the big airlines do. So to summarize, I have them trading at a 54% discount, and airline stocks are really risky because they don't usually make too much money. It's a really tough business to make a profit, but airlines are crucial for the world to keep going. So many people and businesses rely on airlines. So even though they lose a lot of money some years, they always have support, so the government will back them if need be. I don't really like investing in airlines, but when the price gets this low, it can be pretty attractive. So it might be a good time to get in. But if you time it wrong, you'll never make a profit. I rank their free cash flows 3 out of 10, their revenue 8 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.